Fears of a global economic downturn are intensifying as the tariff storm triggered by Donald Trump continues to rattle financial markets. Today, the 25% tariffs on the US steel and aluminum imports officially took effect. For Canada, this levies could be increased to 50%, further escalating trade tensions. Meanwhile, due to the unpredictable policies of the US president, the American stock market has lost approximately $4 trillion in value. Adding to the growing economic uncertainty, the US dollar had been in a downtrend for over a week. As a result, the dollar index against its six major counterparts dropped to a 5-month low. Only in the past 24 hours, the index attempted to rebound, trading today within the range of 103.40 to 103.80. At the same time, recession fears in the US have forced traders to reassess this forecast to Fed Reserve's rate cuts. According to the FEDWATCH, 2-3% of market participants expect the first rate cut at the upcoming meeting on March 19, while over 36% anticipated the next meeting on May 7. So the euro managed to break the critical barrier of 1.0900, reaching the new few months high. At the same time, the single currency is forced to react to the situation with the trade tariffs. However, the EU, represented by European Commission President Ursula von der Leyen, has threatened the US with a shift and proportionate countermeasures. Besides, the announced agreement in the German parliament could be reached in the coming days. As a result, the euro-dollar pair has been attempting to consolidate within the range of 1.0891 to 1.0928 today. Now, the nearest resistance level is at 1.0946. A breakout above this level could push the bills toward the technical level of 1.0969. If the bearish scenario goes ahead, the euro may retreat to the first key support zone at 1.0725, followed by technical indicator levels at 1.0518 and 1.0433. Another influencing can be US inflation reports. The US Labor Department reported today that the annual CPI slid in February from 3 to 2.8%, while the consensus had suggested a downtick to 2.9%. The decline in consumer inflation served as a dovish signal for the Fed Reserve and weakened the US dollar. If producer prices support this trend tomorrow, the greenback will extend its weakness. For more details on the release time of this and other economic data, as well as its potential market impact, check out our traders calendar. Oil prices are also forced to react to Trump's tariff plans, which threaten global economic growth. China's economy is in jeopardy as the US tariffs are already in effect against it. Moreover, OPEC and its allies also plan to increase output rates. US crude oil inventories have twice exceeded forecast, rising by 4.3 million barrels last week. As a result, Brent crude has dropped below $70 per barrel, reaching its lowest levels in 4 years. As for the Russian ruble, it's currently responding to positive geopolitical news. However, how quickly it will reverse its dynamic is in a question. A strong ruble leads to losses in Russia's oil and gas revenues, meaning that the government may attempt to bring it back to the level set in the budget. If sanctions against Russia businesses remain in place, the trade balance will decline, thereby weakening the fundamental support for the ruble this year. So how we're going to be in the short term in financial markets, we will definitely tell you in our next news release. Don't miss them. Subscribe to our channel and follow news with us. And see you!